We are in for a treat on Market Call today. It's Dan Rohinton, Vice President and Portfolio Manager at IA Global Asset Management. Dan is taking your questions on Canadian and global large cap stocks. The toll-free number, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Great to see you, Dan.
Good to see you.
What is surprising you about the market right now? Has anything sort of caught you unawares this year, or you didn't see that coming?
Well, I think Liberation Day would have been a global tariff regime kicking off bilateral tariffs. I think would have been a surprise to anyone. And I think the reaction and just the whittling down and call it the Swiss cheesing of the tariff regime incrementally over time is also the other surprise. But I think what's interesting, if we really take a step back, is where we've gone from speculation of really tough tariff regimes being fully priced in, to now the other direction where the benign outcome quickly being priced in as well.
Yes.
So I think the truth is probably a little bit somewhere in the middle, where you have to have an eye towards caution while also having an eye towards opportunity.
Let's have a look at a year-to-date chart maybe for the S&P 500, because there was despair at one point, extreme pessimism about the prospects of a damaging global trade war. I like your analogy of Swiss cheese. You mean there's holes? It's not just the wall that Trump seemed to be contemplating.
Exactly. And the way to think about it is, and some of the tea leaves that we've talked about and seen through the rumor mill would be that China has let a few imports be exempt from tariffs, the same way the United States has been. So that's the Swiss cheesing effect. There's different ways you can interpret that, right? Is that China letting certain certain imports that are critical to their own manufacturing and their domestic resiliency being exempted from damaging sanctions, damaging tariffs, and is the U.S. doing the same? Or are these green shoots in the whole conversation altogether? And that's why it's important to say that the market is interpreting it as green shoots, where it might be building up domestic resiliency for a bit of a longer haul in this whole thing.
So we've got two guys, Xi Jinping and Trump, and both of them can't be seen to lose face, but maybe they'll finesse something.
Yeah, and that's why it's the tea leaves that matter in this conversation, because they won't say it overtly.
What about AI? I read something funny on Twitter. It was something like ChatGPT. You use it at first, you think it's great. And then you think, well, it's useless, doesn't really do much. But then two or three years' time, you're using it all the time. I mean, these things take a while to mature. Yeah, and the best way to think about it as the original euphoria with the experimentation, with finally implementation. And I think what the interesting point to really, because we're in the midst of earnings season right now, we have seen that from the data, the hyperscalers, as they're known, the big clouds, it's a more common way that they're spoken of, have spoken to strong demand for AI-related workloads and inference workloads, and they've also stood behind their CapEx forecasts. So this earnings season, one of the big stories has really been the sigh of relief if you were selling cheap GPUs and networking equipment to the big cloud companies. It's clear that there is AI demand there, but you don't know, to your point, Andy, if it's very much, call it, experimentation on a grander scale, or if it's truly implementation that we're going through. Have you found any use for it? I mean, you must do a lot of writing in your job. Have you found I'm not saying you get ChatGPT, you write your stuff, but it can be a tool. It can absolutely be a tool, and especially I think the way I would contrast it is areas of deep knowledge, the utility is lower. Areas of, call it, new information that you're trying to digest quickly, there's great utility for that. So that's a very specific portfolio manager type of conversation. But if you take that to the more general knowledge worker economy, I can definitely see how there is greater implementation of this that's going to happen. It's just a trade-off between cost, utility, and how much of the final work can be finally done by these things. But I think the direction of travel is clear, that just like with any technology, it will permeate our lives to a greater extent with time. And you got to make sure that you're buying the companies that are relevant to that at the right valuation, and understand that profit pools can be fleeting in technology, just like every other sector. What do you mean profit pools? So historically, what tends to happen is, if you think back to the tech bubble, Cisco, Nortel would have been huge beneficiaries because everyone's buying all of their equipment. And then over time, you just start whittling those down. So the margin on hardware falls as the margins on software do pick up, and software tends to carry the baton onward. So tech cycles move along with any other cycle, such that
distributors gain power at different points, the manufacturers of the equipment, and the actual service and the application layer. So you got to be careful when you say AI is going to be bigger. That doesn't necessarily mean that NVIDIA's profit pool is going to grow at the rate that investors expect.
We're going to be back with Dan Rohinton, VP and Portfolio Manager at IA Global Asset Management. The topic, Canadian and global large caps. We are back with Dan Rohinton, and Dan is taking your questions on Market Call today on Canadian and global large cap stocks. Let's kick off with an email from Kevin. What do you make of Intel's earnings? Intel out of favor, to put it mildly. Would you be a buyer at this stage?
I would be careful at this phase, and I would avoid the stock. And I'll tell you, Intel is firmly in the land of long-term turnaround, and that's a risky affair.
Yeah.
So they have some assets that they have sold down and trimmed off. And their exposure, when you think about what Intel is facing, is they've got a foundry business that's subscale and needs basically government support to keep competing against TSMC. And at the same time, they have a design business that is successful and profitable, but it's not quite fit for the data center market and the personal computing market in the way that it's going in the future. So I'd be very cautious about Intel. And I would say if you're looking for a quality foundry company, Taiwan Semiconductor offers you most of the benefits of what Intel can offer without the risk of credit events and adverse events that the equity might face.
And your worry here is that Intel faces a long restructuring.
And they've already gone through a long restructuring.
Yeah.
And it took Taiwan Semi a long time to get to this place. So Intel's hoping to leapfrog, but there's mixed signs on whether that's truly working out or not. So the 18A, as it's known, which is their next generation node, they're also giving orders to Taiwan's foundry at the same time. So there's a lot of mixed data points, but I would just say be careful about long-term turnarounds like Intel, even though it could really work out or it could really hurt you.
Right. And can you remind me, are they still meant to be building a giant facility in America, a big chip factory?
Yes.
Right.
And Taiwan Semi is doing so as well.
Okay.
And the hope was that Intel would be, basically Taiwan Semi would be forced to marry up with Intel in some capacity, or there's enough of a domestic, nationalistic push that the Intel foundries could be spun up to a sufficient scale.
I wonder, could that turn into a boondoggle? I mean,
it already is.
It's so really so challenging to catch up.
Yeah.
Okay, we have a caller from Calgary. Go ahead, Rob, please.
Hi, thanks for taking my call.
Pleasure.
I'd be interested in hearing Dan's opinion on HSBC. They've been going through a bit of a restructuring themselves, and I'm wondering if this bank is performing to his expectations relative to others in the financial sector, whether that's European or elsewhere, and if there are others that he might prefer. So thanks again, and have a good weekend.
You too, thanks.
Thank you for the question. So the best way to think about HSBC, it's a global trade finance centric bank. So there's a lot of other pieces to the puzzle, but more than anything, I would say there's probably more domestic options available that are equally high quality. So think of a DBS group in Singapore if you want a more Asia-centric bank. If you want a more domestic continental European bank, maybe a BNP Paribas can better fit that conversation. And more domestically in the United States, you can look towards a JP Morgan or a Bank of America. So HSBC in many ways is a beneficiary and has been for a very long time about globalization, and especially globalization through the prism of trade. And that's moving in a slightly different direction. So I'd be cautious because HSBC as a whole is run well, their deposit footprint's okay, there's nothing individually wrong with that, but I would just encourage a more localized approach. And I'd say maybe stay a little bit more local in Europe, and maybe BNP Paribas can offer that for you.
I'm just thinking about globalization. David Olive in The Star today writing that Canadians are looking at empty shelves in the near future with tariffs and disruption of trade networks. And that's going to be interesting. That's just because people will be frustrated. I guess some of us will think, well, do we really need a new giant TV? Do we really need strawberries in February? But it will be tough on retailers.
It's a complicated dynamic, right? So you're seeing a major reorienting of global trade flows. I think if you really zoom out from, call it, next week or next month's container shipments and what the data flow on that, which is quite choppy, is over time, there was already what was known as a China plus one strategy happening in global trade. And I'll give you a perfect example. Apple last night was talking about how they're building more of their iPhones set for the US market, not in China, but in India. And that's that China plus one. So you have your footprint in China, but you're adding another country in a major manufacturing node, sometimes more locally like Mexico, sometimes further away like India or Malaysia or Indonesia. But the point being is that you're less sensitive to one bilateral trade corridor as it's known. So this is just a question of, in the short term, there may or may not be empty shelves, depending on whether the containers show up with a giant tariff or not. But over time, you can rest assured that globalization and global trade flows do tend to, call it, arbitrage themselves away.
John is in London, Ontario. Go ahead, John, please.
My question's on Honeywell, the industrial complex, which plans to split into 2 or 3 entities soon. This reminds me of General Electric, which I'm a long-time holder. GE did very well after the split, and all 3 of its components are doing well. Do you see another GE in the offing? Thanks very much, Dan.
Thank you.
Yeah, I think Honeywell is a bit of a different conversation. I would tell you that multi-industrials, they do tend to go through their periods. We went through the big industrial conglomerate phase decades ago. Now we're in the, call it the splitting off and the specialization phase. So I do think Honeywell is in that category, but I wouldn't say that the sort of the idiosyncratic reasons why GE was such a success story, and I still think many parts of GE still are, which we'll get to later, I'm sure. Honeywell is a bit more, there wasn't as much wrong necessarily with the ship, and the divisions were broadly functioning on their own. So this is just more of a optimization conversation as opposed to a major re-architecting with Larry Culp that happened with General Electric. So I think same flavor, different beta to the same conversation.
It's interesting. I'm just thinking about Canadian banks. They like to become conglomerates by buying stuff in the United States. Should they even do that? Because they may see there's synergy, but is there really?
No. My opinion's been for a very long time. And I'll give you a perfect example. So Canadian bank ROEs, and it's a little messy with corporate accounting and all that, 20% to 30% in domestic personal and commercial banking.
Fantastically profitable.
Fantastically profitable, perfectly said. The US, you're talking about 10%, and that's before you get fined and regulated and all the other issues that come along with it. So my personal belief has been that the Canadian banks should be domestic pure play entities, and it's this period of time where the US banks have done this as well, where they hived off assets. So we're in the hoarding phase right now of the Canadian banks, where they're buying more and more stuff. There may be a time where we see divestitures in the future. I'm not saying that it's on the way, but the contrast is clear. 30% ROEs, or 20 if you're fully corporately loading it, or 10, but really 7 if you're also corporately loading it at the same time. In my mind, the answer is obvious. Canadians should stay in Canada in the Canadian banking space because that's where the profits are.
Yeah, if I hold 1,000 shares in a bank, I don't care if your grandiosity and you get a bigger paycheck. I just want more profit per share for me
100%,
on my shares.
100%. Per share, earnings per share, and total return per share is what matters for us. Whether you have 100,000 employees or 1 million is irrelevant.
Dan Rohinton is our guest today. Dan is taking your questions on Canadian and global large cap stocks. We'll be right back. We have Marge calling from Lethbridge, Alberta, in the south of the province. Go ahead, Marge, please.
Yes, Dan was on Market Call a couple of months ago talking about European defense stocks, and I'd like to know, like ETFs, and I'd like to know what the cost is, the dividend, and the MER.
That was DPS, I believe, Marge said.
Yeah, I'm nice to see you again, Marge. For our purposes, we tend to do individual stocks, and ETFs are not a part of what we do. So I can't quite comment on that per se. But I will tell you, I've been pretty vocal in saying that I do think companies like a Rheinmetall, albeit the margin of safety of that is significantly less so. So I'm far less constructive on European defense than I was a few months ago. But when you think about defense stocks around the world, Europe is by far the best place to be in the grander scheme of things. The reason why is European defense budgets are rising significantly, and in a way we haven't seen in, frankly, a generation, maybe even two. So we're talking about Germany, which used to spend less than 2% of its annual GDP, GDP on its defense, moving closer to 3% and greater. And for a domestic leader, which captures a big share of that, like a Rheinmetall, that's how we've chosen to participate in that, because we think a vertically integrated, multi-platform company like Rheinmetall is well positioned. The only thing today now is we're having to look forward, not just what the next 2 years will bring, but 3, 4, 5 years from that. So I am less constructive on it, but at the right price, at the right dips, I do think a Rheinmetall, a Leonardo, and even a BAE would be a good place in the defense sphere to look overall.
Rheinmetall hitting a record high today, and they are. I mean, they're diversified. They're in all kinds of engineering, but people I think, are buying them because of the defense.
Yeah.
Yeah,
it's about 90% defense, and specifically it's also what's known as short cycle defense. So it's basically the artillery shells to replenish the stocks for Ukraine and things like that, as opposed to BAE Systems and Leonardo and Dassault Aviation, which would be the fighter jets and what have you. So industrials, when you think more broadly, industrial companies are either short cycle or long cycle. Short cycle are those quick turnarounds like a Parker Hannifin. Long cycle is in aerospace sector, and defense has those same dynamics as well.
They are apparently developing the Panther KF-51 tank that's aimed at replacing the Leopard 2. And they've teamed up with Leonardo to build a variant for Italy. I mean, it sounds cool, a new tank, but what a waste of human resources.
For sure.
It's a pity our society has to do that. Marge, thanks for the question. Nizar is in Scarborough, Ontario. Go ahead, please.
Hi, Andy. Hi, Dan. May I have your thoughts on Brookfield Infrastructure Partners, please? With Mr. Carney now in charge, there has been talk of huge spending. Will this stock see upside, or will Trump tariffs impede future growth prospects? Is it a buy for dividend yield and growth, or would you rather own the parent, Brookfield Corp? Thanks for taking my call.
Thanks.
Yeah, I think one good framework when to think about the Brookfield complex as a whole is the closer you are to the top of the house. So Brookfield Asset Management or Brookfield Corp, which is BN. You're closer to the CEO, so the incentives and the board. So the incentive structures tend to favor the further up you go. So I would say Brookfield Asset Management can offer you the yield and, broadly speaking, the growth aspects. If Brookfield Corp, which doesn't have the yield but has the carry and some of the upside, can also play a role there. So I would say Brookfield Infrastructure Partners, the way to think about it is it's not really whether Mark Carney got elected or not. It's not really about the tariffs per se, because it's really a global business and it touches a lot of different areas like infrastructure. It touches a lot of other areas like toll roads, coal, things like that. So it's very diversified in that way. So it's bigger than one person or one tariff regime. But I would say, as a philosophy, when it comes to Brookfield, you want to stay as close to the top of the house as possible. So I'd encourage you to look a little closer to, say, a Brookfield Asset Management or a Brookfield Corp, depending on how much yield you need for your life circumstances.
Bob is calling from Bowmanville, Ontario. Go ahead, Bob, please.
Yes, Dan. I was wondering if you can give me your thoughts on Eli Lilly. It's having a nice bounce today. Would you consider this to be a good entry point?
Yeah, and I think for Eli Lilly, so just to give a little flavor to our friends across the screen, Eli Lilly, it was a diabetes company. It's primarily an obesity-focused company now, just given the significant growth that Mounjaro and Zepbound would have had. So the GLP-1 stocks, Eli Lilly is the more successful of the two compared to Novo Nordisk, which is its direct peer. I think it is a decent entry point for the company, but I think it's important to acknowledge that when you're a pharmaceutical company trading at, I believe, about in the 30s times forward earnings.
Let me have a look.
There is a strong expectation of scripts growth. And there's every reason to believe that's going to happen, which is why I do think it's a decent entry point. But I would be cautious on positioning sizes, because what is increasingly, and if you just zoom in the screen a little bit to the last few weeks, the reason why the stock was down 10% yesterday is that Novo Nordisk had a deal with, I believe, CVS Aetna to become the primary recommended product for obesity, for treatment for obesity. Why is that important? That's an indication that because Eli Lilly's products are better and have a better clinical outcome, Novo Nordisk is starting to compete more on price with Ozempic, Wegovy. So that is what is causing some of the volatility in the equity. So I do think it's an attractive buying point, but I think I'd be cautious to not make it a max weight aggressive position in the portfolio either. This is an example where diversification is really important to the conversation.
There's a headline on Bloomberg: obesity drug war price wars heat up. Yeah.
Yes.
It is interesting, though, the power of these pharmacy benefit managers in the United States. And I know concerns are being expressed.
And I'll tell you, just to quickly add, when you do speak to the companies, it's very obvious that prices are going to come down as capacity and what's known as scripts scale. So it's very common that in the early phases of a treatment, when it's either prescribed off-label or it initially enters the formulary, it is going to be a higher price than what it inevitably ends up at. So I expect these things to get demonstrably cheaper, but I expect the patient population to be growing commensurately as well. That tends to be the trade-off.
We're going to take a quick break. When we return, we'll have a look at Dan's past picks. Dan Rohinton is taking your questions today on global and Canadian stocks. Let's have a look at some past picks. He was on our show July 25th of last year. Linde, the big player in industrial gases, was his idea. Fairly flat over the period.
Yeah, and in this type of environment with the turbulence, I'll take that as a win. And when you think about Linde, really the story hasn't changed. So industrial gas, defensive end markets, you get to participate in the industrial expansion of the economy across different sectors, whether it's steel mills or semiconductor facilities, and you do it in a way where it's a decent dividend compounder and an earnings grower. So it's a past pick, but I would still make it a pick today.
Okay. Yeah, and I mean, it's a natural oligopoly, isn't it, really? Industrial gases is so capital intensive. And
yeah, only three in the game in any scale.
It's interesting, isn't it? Because they're selling to sophisticated customers. It's interesting how you get, when sophisticated big players are up against each other in pricing. Yeah.
And what ended up happening in this environment, along with rails and a lot of other sectors, is you go through a period of fragmentation for decades, and then you go through a period of consolidation. So industrial gases was far less rational if you look back 30, 40 years than it is today. So the same was true for railroads during the rail bubble and so on and so forth. But once an industry gets more mature, it tends to get more consolidated. And once it's more consolidated, the returns tend to stabilize at a reasonable level.
But it's not always great for the customers, I suppose.
That's right.
Yeah, that's the face-off. Let's see how Mastercard has done. Of course, a toll collector on the global economy, just like Visa. Not a bad return, 30%.
Yep, and I would tell you, Mastercard's one of those beneficiaries where valuation and the stabilization, the fundamentals has come through. I think it's one of those companies where, depending on the level, this is a core holding. It's just a question of how you want to position it in a diversified portfolio. So the valuation's reset. I'm not as constructive on it, but it's a core part of the portfolio and has been for a decade now.
And then your final one, I'm not sure how to say it. If you try to say a Danish word and you're not Danish, you're bound to get it wrong. Trig?
Trig, yeah, okay. That's okay, close enough, right? So think of it as the intact financial of the Scandinavian states. And diversified company, good dividend yielder. There was a short-term hiccup in call it around the Liberation Day period, but that's more, call it spurious correlation than actually anything related to tariffs. The reason behind that is there's a competition review happening in one of their countries, and that's where the market's starting pricing in a scenario of more price competition. But I think more than anything, think of it as a stable part of the portfolio. It's still with us today in our diversified portfolios, and I expect it to be in the future as well, just as it has been in the past with these other top picks.
Interesting how the Danes have hung on to the kroner. They didn't go down the euro route. Yeah.
But it's effectively, it's like with Switzerland and Poland and what have you, it's all anchored to the European Union for the most part. So it's sort of a little bit of flavor on top of the broad currency bloc that is the EU.
We're going to be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. David is calling from Ottawa. Go ahead, David, please.
Good afternoon. Thank you for taking my call.
Pleasure.
My question is on Bank of Montreal. Given the fact that Trump and Mr. Carney, they seem to have a better relationship than with Trudeau, and Mr. Carney is going to be in the States, and do you think this is going to be positive or better for Canada regarding the tariffs? And do you think this is going to be positive for Bank of Montreal, because since BMO has a large footprint in the United States? Thank you very much. And also, do you own Bank of Montreal for yourself and for your clients? Thank you very much. Have a great day.
Thank you very much.
Yeah, thank you for the question. So I'll tell you just, there's a lot of, I would be careful to conflate tariffs, politics with the direct fundamentals of a business, and especially even a bank, even though sometimes those things can intertwine. So for BMO, the way to think about it is it's a bi-coastal U.S. bank and a Canadian, bit more commercially skewed bank versus the other banks being a bit more on the personal side. So I think BMO as an equity story is, broadly speaking, think of it as a mid to large cap bank that's both got businesses north and south of the border. That doesn't necessarily mean that they interrelate too much, though. So Bank of the West, I forget, Harris Bank in the Midwest, which were the acquisitions that BMO did to scale up what they have today, they kind of operate broadly on their own. So is a better U.S. economy and a better Canadian economy good for BMO? Yes, it is. But I wouldn't say that the tariff regime is necessarily a direct input factor there. So I think the biggest risk to BMO, along with the other Canadian banks in broadly the same proportion, is that the Canadian consumer does weaken, and so do commercial credits. I would see that's what I would be worried about, along with U.S. economic slowdown. But I would not interrelate the two. So I think we don't own BMO today. I think we're taking a more cautious approach with owning the more, call it diversified banks and an RBC and TD primarily on a valuation basis. But I do think BMO should be part of the roster. I do think BMO is interesting at the right valuation. It's just something we've chosen to focus more, a little bit different in our Canadian portfolios, which is to own fewer banks, more personal property and casualty insurance, and then owning a little bit of payments for diversification. So nothing wrong with BMO, nothing against BMO, but do think of it as a broad, diversified banking entity where the politics don't come into play per se.
Ray is standing by in Pickering, Ontario. Ray, you're on the air.
Good day, guys.
Hey, Ray.
Dan, I've been watching Constellation Software for a long time, and watching Market Call for a long time. I've never heard a fund manager say anything negative about this stock, and yet I'm just been. I don't understand. Maybe you can explain to me why, fund managers would ignore a PE that's over 100, and And again, if you can explain maybe if there's any potential for a stock split, because I'd buy the stock in a heartbeat if there was a stock split. So maybe you could help put on those two factors.
And the stock hitting a record high above $5,000 today.
Yep. So I'll unpack it. So the best way to think about Constellation Software is that their claim to fame, and they've done so with tremendous, tremendous success, has been to find stable cash flowing assets, buying them right. And then that's really been the reason for why it's been the true success story for frankly, a decade plus now. So I'll tell you something potentially negative about Constellation is, are they hitting the law of large numbers? Is the regime that has led to a decade of tremendous success for the equity story different today? So now they need chunkier, larger deals to run that same playbook at the same time that other players like private equity and more, really I'll just leave it at private equity, but more sophisticated capital markets players have come around to the same idea that Constellation has had as well. So it means bigger equity checks, more competitive equity checks that Constellation has to cut and compete against. I think that's what I would have reservations about on an ongoing basis for Constellation, but it is one of the great Canadian success stories and has been for a very long time for the reasons I described before. Well, as it relates to the price to earnings ratio, I think I'd be a little bit careful when you're looking at valuation there. It's not cheap by any stretch, but you have to look at it on free cash flow per share and compare that free cash flow per share growth, because PE tends to be a bit messy when you have depreciation running through, and especially for a company like this, it's a bit complicated because PE ratio muddles in a lot of those things. So I would encourage you to look at free cash flow per share for Constellation and use that as the basis for valuation. So I don't think it's cheap today. I do think it's a core position in Canadian portfolios, and we do own it today. But that's where I would take a little pause. It's really on valuation, but it's nowhere near as exorbitant as the PE ratio would suggest.
Can you just remind me, do some brokers offer an opportunity to buy just a portion of the shares?
Yeah, it's known as fractional shares. I'm not quite sure how that would work, because it really depends on the individual account and what have you. But what you're describing is what's known as fractional shares.
Yeah. We should do a segment on that sometime, yeah. Anne, we'll squeeze in a caller here. Anne in Scarborough, Ontario. Go ahead, please. I don't hear Anne. Kamico is the question.
Yeah, so I'm sure the question on Kamico is it attractive today? I think it's a bit more of a complicated question, but I would think of it as a core position in the Canadian context, because uranium has really come into its own. And outside of very speculative early stage companies, Kamico has the best of the low-cost production side of uranium, and at the same time as they have uranium, basically nuclear servicing operations in what is their 50% ownership in Westinghouse. So I do think it's interesting. I do think it's something you should keep in mind. I don't think it's necessarily a jump in with both feet opportunity today, but it is something you should always keep a focus on.
Okay, we are going to take a break. We're going to be back with Dan Rohinton of IA Global Asset Management, Canadian and Global Large Caps. We've got Sal on the line from Toronto. Go ahead, Sal, please.
Hi there. Yeah, my W. It seems to have a good diversified revenue stream from various countries, and it seemed to have good earnings last time around. I was wondering if now would be a good time to enter into a position, understanding that there's been a big shareholder recently who's been selling off a chunk at, I think, 242 or something like that. So wondering if now it's a good time or if I should be waiting around for a better entry point. Thanks so much.
Thanks.
Yeah, so WSP Global, it's a big engineering and design firm. It's a high-quality company in a high-quality part of the value chain. And I would say that the valuation is the only real sticking point here. So you can expect them to buy more of their competitors. You can expect them to integrate it well. And think of SNC and Stantec as the near peer. So I think WSP is a good core long-term holding. I'd just say maybe pick your spots in buying it today. So we have it as effectively a lower minimum weight in our Canadian portfolio, and I think that's a good way to think about it. So in the context of Canada, great opportunity, and I would just be a little cautious on how quickly to add to it today. But I would say I'd be a buyer over time.
Right. So the case to Depot sold just over 2 million shares at just under $243. I'm kind of interested. WSP is obviously a brain power company based in Canada. And obviously a big part of our future is that kind of company rather than manufacturing. But does it add that much value to the Canadian economy? I'm not saying anything against it, but a lot of the employees are abroad, if you see what I mean.
Well, I think the best way to think about it is the headquarters and any indirect clustering benefits do exist.
Yeah.
So the same way that back in the day, it would have been great if what became the Apple supercluster in Silicon Valley was the Research in Motion supercluster that was in Waterloo, Ontario.
Yeah.
So while these businesses are global and the assembly operations are very different, like truly they do design and human capital, and someone else does the digging for you. So wherever that road is being built is where that road is being built.
Yeah.
It doesn't hurt that the human capital, because there are network effects there in building up those capabilities. That's how Silicon Valley started. It wasn't Apple, but I'm just saying there was a company before that called Fairchild Semiconductor that kicked off what Silicon Valley became. If Research in Motion had been as successful as it could have hopefully been and beaten the iPhone to the punch, Waterloo, Ontario could have been a far bigger cluster for that human capital. And that's why these things, even though they aren't direct beneficiaries, it does matter long term.
Yeah, it's interesting. And I mean, that is the economy of the future, though, presumably intellectual property.
That's right.
As Jim Balsillie, formerly of Research in Motion, likes to say. Chetan is in Toronto. Go ahead, Chetan, please.
Good afternoon, gentlemen. My question is regarding United Health. It came back significantly. Is it a good entry point for a long-term hold? Thank you very much for your reply.
Thank you.
Thank you.
So the short answer is yes. I strongly believe so. But I would tell you just the reasons why, when you think about just the reason why that the stock went from effectively around 600 to in the 398, 400 range today, is that they were caught in a position where they took on basically their primary care clinics. They had undercoded those patients. So the care that they had to provide was effectively someone who you would say was a mild patient in terms of the surgeries and the care you needed to do. It was a lot more. They were a lot more acute and a lot sicker than that. So when it comes to getting payment from the government and from the insurance plans, basically the patients that they were treating, they weren't getting the same revenue as they should have for them, to the tune of almost $500 per month per patient. So that's where the $3 billion plus disappeared in terms of United Health's revenue, and that hits profit nearly completely. So I think this is potentially a generational buying opportunity in United Health. But I would also tell you that it really depends on how quickly they can recode. Is the guidance that they're saying accurate and commensurate with that? So I would say absolutely yes, that's my conviction, and we're buyers of the stock. Just as we've been averaging down in our position the whole way through and are buyers today, but we are keeping an open mind that was this exactly as they laid out, or is there something more functional changing in the ever-evolving U.S. healthcare system? So yes, but be mindful that the facts might change.
That's interesting. A yield of about 2.1%, but so enormous profitability potentially, but you're waiting to see if these problems are transitory.
No, we're buying today. I'm just saying. No. It's important to clarify that.
Yeah.
I think it's an attractive buying opportunity today. I'm just saying that it's based on the reasons and the fundamentals that have been articulated by management. And I want to make sure and this is a process for all companies, but when a stock is down over 35% from its highs, it's important even more so in a situation like this. We're going to keep a track to make sure that the reasons that the Optum Health shortfall and the Medicare Advantage shortfall is that going to be lining up and syncing up in upcoming quarters? So from the information we have today, I think it's a generational buying opportunity in United Health, but I'm mindful and honest enough with myself to say that if we're wrong on the facts, we will also change our mind.
We're going to have to drop the last caller. I'm sorry. Apparently there's a musical about the killer of that United Healthcare executive. It seems in questionable taste.
Yeah.
I mean, the guy's a killer.
That seems immoral.
Yeah. Okay, but we're going to get the top picks coming up from Dan.
It always comes down to
Let's get Dan and I. Dan is such a mine of information. I like to hear what he has to say. Amazon is Dan's first idea.
Yeah, so when you think about what's going on in with the tariff regime and what may or may not happen, whether it's a Swiss cheese settlement or a grand bargain, when you think about retail, there's no more dominant company than Amazon, Costco, and Walmart, of which Amazon is by far the biggest discount to any of the other peers that you talk about in the same vein. At the same time, they have the leading cloud computing company, hyperscaler, cloud computing, tomato, and Amazon Web Services. So you have the best diversification in terms of cash flow, but more than anything, you're buying a Costco, Walmart at a big discount when arguably it's the better of the bunch. At the same time, as you own the leading company in the cloud computing sphere with the most diversified footprint there, which has stable margins and expanding margins as well. So I think Amazon is extremely attractive today, and the uncertainty that you don't know for sure how the turnout is going to be, but they're going to win in retail, whatever that retail environment looks like, and you have the cash flow support that comes from Amazon Web Services. I think it's a no-brainer. And
they have their fingerprints all over e-commerce. Even if you don't buy on Amazon, they're involved often in getting you the package.
Exactly, yep.
GE Aerospace, a play on the aviation industry.
Yeah, and this is one of those companies, when you think about it, GE Aero is a quality long cycle industrial company. And what they make is airplane engines, which go into the new generation planes, but also the older generation planes that are already flying. So you're somewhat agnostic. It's not quite as simple as I'm describing it, but you're broadly agnostic to whether older planes are flying or newer planes are being built and delivered. So you get the best of both worlds of original equipment and aftermarket in a company that's in a critical part of the value chain, and the order book is so long that it's really in GE's control to actually deliver the engines. So it's very much an environment in industrials where you control your own future, and that's not always true.
And as far as I know, global aviation is still set for massive expansion in the decades ahead.
And it tends to be a bit more recession resilient than you would normally think. And the reason for that is when we think of aerospace, we think of Air Canada or a WestJet or a Southern Airlines, things like that. When really the aerospace value chain, the building of the planes, is so much more consistent than that, because you don't have to deal with fuel prices and booking windows and anything of the sort. So we like this value chain, we like this piece of the value chain, and we think that that long demand runway really adds support, and it's run by a great team.
Okay, and is it essentially a duopoly with Pratt & Whitney, or is there elements of that?
Largely so. They're known as different, there's Rolls-Royce, Pratt & Whitney, then there's also General Electric with Safran. So there's different consortiums as they're known, but broadly speaking, yes, and GE is on the winning end of that consortium with the new LEAP engine.
Danaher, big player in medical supplies.
Yeah, and think of this as another diversified diagnostics and bioprocessing franchise. So this is a good capital allocator. So I would tell you that they're cyclical businesses, which come with far less cyclicality than most other sectors we talk about. Danaher is on the upswing there, but more so, Danaher has an underdeployed balance sheet at a time when valuations, until recently, were coming down. So when markets are choppy and the earlier stage companies are getting more on sale, you have what is a cyclical upswing in their bioprocessing business. Diagnostics will do okay as well, at the same time as the balance sheet could potentially be deployed in an accretive manner. So we think it's a good healthcare defensive stock to own.
Stock has drifted down. I imagine it went up a lot during COVID with all the medical research, but it's been down over the past few years.
Yeah, there's been a big derating across Danaher and also their peer Thermo Fisher, which are the two main companies that are spoken about in roughly the same breath. And what was going on is in the early days of COVID, there was a lot of COVID-related testing revenues. So they saw a huge profit boom and a revenue boom and an even bigger profit boom. And those COVID revenues have tapered off. But what's also happened is that there's also a segment known as like the bioprocessing segment, where it's more levered to actual like manufacturing and production volumes. And that's actually been on a downswing. So that's why that cyclical upswing, I think, is on the way, along with more complex treatments, which is a beneficial dynamic for a company like Danaher and also Thermo Fisher as well.
And Bloomberg Intelligence argues that over the years they've been very good at acquisitions, mergers and acquisitions.
They're one of the best acquirers in the industrial space. And then they said they spun out basically their industrials footprint to something else. And then they shifted more towards healthcare because healthcare is a more resilient vertical than industrial. So it's a great capital allocator. And this is potentially a time that they could be allocating that capital.
Dan, we're almost out of time. How much time do we have, control room, please? We've only a minute. What is your reaction, if you can give us a quick one, to GM losing the third shift at Oshawa? Should we be worried about our auto assembly? I'm sorry, we've only a minute.
Yeah, no, of course. I think it is a tough environment in autos. So there's two things happening at the same time. The first is the what's known as ICE vehicles, combustion engines, have been losing market share around the world to electric vehicles. So the nature of the industrial plant has to change anyway. And I think the awkward conversation as Canadians that we have, and I lived right next to that plant. Literally, I could see that facility from my window when I was a kid. That facility and others in Ontario have a tough dynamic because they're going to be competing with the southern U.S. facilities, maybe some facilities in Mexico. So I remember that facility and how it shrank with every crisis. And I think the shift in the industrial plant is one headwind, but I think the problem that comes with just the trade tensions, I don't think that helps. So that's a really tough news story to hear.
Dan, I gave you no time there, but thank you very much indeed.
Thank you.
Dan Rohinton has been our guest. Thanks very much indeed for watching Market Call.